Hello and welcome back to the next episode of Risk versus Reward. As always, we have with us Hari Vishwanath, who leads our investment bureau team. It brings out the product called Portfolio. Welcome back, Hari. Nice to have you with us.
Thank you, Bharat.
This week, it's right up Hari's alley again. All the IT services companies of India Heritage have announced their results, and Hari's written about their numbers. So let's look forward to an invigorating session on how Hari dissects these numbers and what he thinks these numbers mean in the context of the AI era. Hari, in your article in the most recent edition of Portfolio last Sunday, you talk about the contradictions in terms of expectations by the management of IT services companies and that of the investors.
Yes.
You also quote top industrialist Mr. Anand Mahindra saying, if anything, in the AI era, there are ways in which the importance of IT services companies will actually increase.
Yes.
What is your view on that?
So this is one of the reasons why we decided to write this article. We figured there is a big difference between what management is stating or what the board members are stating versus what investors are expressing in the stock market. The investors are basically giving their verdict in the stock markets. IT stocks have been routed, and so there are multiple bounce attempts, but then the stocks again fall. So it's been a longish bearish phase for IT stocks, and the results are very lackluster. Okay, but every time the results, especially this result season, okay, Accenture reported 1 month back, Infosys reported last week. So during this 1 month period, Accenture to Infosys, all major IT companies have reported. Okay, everyone says the results are strong. Every management says the results are strong. But when you look at the numbers, the growth rate is 2%, 3%, 4%. Okay, I mean, these are not strong numbers in my opinion, and I think many would agree with it, although everyone is entitled to their opinion. 2%, 3%, 4% growth is not strong by any means. These are companies that have grown in double digits, higher double digits, over 20% also during good years. Okay, so those were strong results, not this. So the management appears to believe, from what they are talking in their earnings conference call, which I saw for all the companies this time, they appear to believe their results are strong. The stocks, sentiment on the stocks is extremely negative, and at the same time, there is a big gap. Okay, so there is a gap between what the management is saying and what the sentiment of the investors. So who is right? That is what we wanted to touch upon in the article we wrote last week. So in this case, when Mr. Anand Mahindra said that the relevance of IT companies will be more important in an AI era, this is something that also we wanted to cover. See, the thing is, if any company becomes important in a new era, at some point of time it should start reflecting in numbers. It should start reflecting in revenue growth. It should start reflecting in margins, or in both, ideally in both. If you are important, your revenue growth will be strong, your margins will be higher than what it was before. So we did this comparison. We split IT companies into 4 phases in the last 16 years, okay? FY10 to FY15.
So Hari, I'm sorry to interject here, but in your article, and this was actually, you probably started off answering my next question itself. In the article, you talked about having to understand the future by looking at the past.
Yes.
And that gives you a view into what lessons could be learned. And the very point that you mentioned, and I was curious about that. So what are those 4 phases? Because I thought I have been observing the IT industry, and we talked about the dot-com burst and the financial services scandal of 2008, and then the digital era that you referred to, and then the COVID challenges, and then the rise just after COVID hit us.
Yes.
Right? So what are those 4 phases in the last decade and a half that you are referring to?
See, the 4 phases is what I'm splitting the last 16 years into a boom phase, FY10 to 15. Post the global financial crisis, there was a hit. Then there was an outsourcing wave. Every company wanted to cut costs post the global financial crisis, and that was a pretty good period for the businesses actually, for IT services business. Revenues boomed actually. FY10 to FY15. FY16 beginning onwards, end FY15 or early FY16, the digital disruption started impacting their business. Okay, so basically FY 10 to 15 was also a period where many of the cloud companies were flourishing in the US, and they expanded their business globally. So as digital and cloud business started flourishing, by FY 15, FY 16, it started impacting the legacy IT services business. Okay, so FY 16 to FY 18, the 3-year period was a period of pretty serious disruption for the industry, where the revenue for all the companies took a big hit. Okay, so but during this, by the end of FY 18, they successfully transitioned. During this 3-year period, the common message from management and board was Indian IT will evolve, adapt, and deal with this transition. Okay, managements both said that when the slowdown was happening, they were right. By FY 18, the transition was successfully implemented. Business again started doing well from FY 19. So the first phase was FY 10 to 15. Then is the disruption phase, FY 15 to FY 18. Then from FY 18 to FY 23, another 5-year period was another boom period. Okay, the business did very well because the transition had been successfully implemented by end of FY 18. Business started growing pretty strongly from FY 19 onwards. COVID came, but it was a blip. Actually, the digitization boom actually benefited them immensely because they were well positioned for the digital wave. Okay, so FY 18 to 23, end of FY 18 to end of FY 23 was the second boom phase. First boom phase was FY 10 to 15. Second phase was FY 18 end to FY 23, 2 5-year periods. Okay, now successful transition. But here are some of the important numbers you need to note. Like if you can see in the charts which we are showing up, the revenue of TCS in the first phase was 20% CAGR during the 5-year period, FY 10 to FY 15. During the second boom phase, which is phase 3, FY 18 to FY 23, the revenue CAGR was 8%.
CAGR is compounded annual growth rate.
Compounded annual growth rate fell from 20% in a 5-year period during one boom period to 8% in the next boom period. Net profit CAGR fell from 17% CAGR in the first boom phase to 6% CAGR in the second boom phase. Okay, so do you see the difference? Successful transition, but revenue growth and profit growth tapered significantly. Okay, one point you can make is that as companies grow, revenue growth will taper. Okay, because larger base. Okay, but at least your margin should not decrease. Okay, at least your margin should not decrease. But in phase 1, the margin of the company was 26%. For TCS, it was 26%. It fell to 24% in phase 3. Okay, so you compare these two periods. IT companies, you could theoretically say, theoretically or for all practical purposes, you can say their importance reduced in the digital phase actually, which is why your margins come down. Okay, if your margins are coming down, it means only one thing: you don't have pricing power. There is competition. When you don't have pricing power, when there is competition, you are less important.
Awesome. That's very lucid.
Okay, so I will give you some more numbers. I would like to run through all these charts. For Infosys, all these, the numbers I'm giving is in dollar, okay, in dollar terms, okay, because assessing the business in dollar terms gives the underlying, helps you understand the actual underlying business, because they mainly bill in dollars to foreign companies. Okay, so for Infosys, if you see in the chart, the revenue CAGR came down from 13% in phase 1 to 11%. Okay, less of a hit than TCS, but still a hit. Net profit CAGR fell from 9% to 4%. Okay, from 9% it fell to 4% in what is supposedly a boom phase. Okay, margins fell from 26% to 21%. That's a massive hit in margins. Then let us take all the companies combined. Okay, so in this chart you can see that we have for the top 5 companies, which is TCS, Infosys, HCL Tech, Wipro, and Tech Mahindra, top 5 IT companies. These 5 companies account for 85% of the top 10 players in the business. Okay, so you can see that the top 5 in this business are significantly larger than the next 5. So the next 5 are much smaller. There is no comparison. Okay, so these 5 companies combined give you a large indicator of the underlying trend in the industry as a whole. They account for roughly 85% of the top 10 players' revenue. Okay, so when I combine these companies, in phase 1, 14% was the revenue CAGR. Okay, in phase 3 it was 9%. From 14% it came down to 9%. Okay, and then EBIT margin combined, it fell from 24% to 20%. So which means importance has diminished. That's a fact that everyone has to admit. Okay, with each tech disruption, it appears the importance of India's IT services companies is diminishing. And I'm not surprised it is diminishing because, see, for your importance to grow, you have to invest. You have to invest in newer things, newer technologies. Only then you become more important. It's like I always tell this, you can't be fit without going to the gym or doing yoga. Okay, so similarly, companies can't grow for too long at a decent growth rate without investing. So there has been an excessive focus, which we have spoken of before also, on shareholder returns. Lack of investments has resulted in IT companies, in my opinion, becoming less important. I believe as things are, as the information is flowing right now, same thing that happened between phase 1 and phase 3, after they transition to the post-AI world, they will transition like they did during the digital disruption, but their importance will be more diminished than what it is today. Now let me make one more point. The top 5, okay, their combined revenue grew at a CAGR of just 2% in the last 3 years. I call this FY23 to FY26 as phase 4. Okay, which is the most severe disruption. Phase 1 was growth. Phase 2 was the first disruption, digital. Phase 3 was another boom period. Phase 4 is the massive AI disruption of the last 3 years. Revenue CAGR is 2%. Okay, and net profit CAGR is also 2% in these 3 years. I mean, these are almost like sunset industry growth rates. So my sense, as things stand now, is that their revenue growth, once they successfully transition post this AI disruption, will be better than this 2% revenue CAGR of phase 4. Okay, but it can be lower than the 9% growth they registered in phase 3. So you are looking at around mid-single digit US dollar revenue growth, and the net profit growth during phase 3 was 5% net profit CAGR. You're probably looking in dollar terms lesser than that if competition increases, because AI makes even smaller companies more powerful. See, with each tech disruption, another thing that is happening is the less empowered, whether it is an individual employee or a corporation, everyone who was smaller in size relatively gets more empowered with each tech disruption. The competition actually increased after the digital disruption. It is going to increase more for the larger players after this AI disruption. So investors have to consider the possibility that companies will become less important, not more important as some managements and boards claim. This is my perspective as of now. Maybe if any data comes to make me reconsider this, I'll be happy to change my perspective.
So this brings us to the final question of this episode, Hari. In your article, you advise investors, you urge them to look at not just valuations, but also the strategies that companies are pursuing.
Yeah.
Wise advice, in my opinion. But if I have to pick your brains a bit more, isn't this what good investing always recommended? Like Mr. Warren Buffett has always talked about great companies, but at good valuations.
Yes.
It's also the point of the time of the value at which you enter the stock.
Yes. Yes. So, I mean, you look at the history, I see them as great companies. I am not sure how the future is going to evolve. All I can say, as I said earlier, was I think their importance is going to diminish unless they invest in the next frontiers of technology, have second engines of growth. Okay, see, companies to last multiple decades and continue to grow over those decades need to have multiple engines of growth. You can't be relying only on one business. IT services alone cannot be the business, okay? You have to invest for a newer business. I'll tell you this, okay? This debate has been going on in the industry, okay? Why didn't the IT companies invest? There are other people who defend it, saying everyone cannot do everything. It is better to return the money to shareholders rather than make an investment and burn the money and it fails, okay? See, but this is one example I like to give, okay? What was Amazon? Amazon was a seller of books online, and then it went into cloud business. These two are as far apart businesses as any. Microsoft was a software products company. It went into cloud business. It invested in cloud. I mean, these businesses are different. So if you see a common theme in companies that have been extremely successful for a very long time is you invest in second engines of growth. Otherwise, you are at the mercy of the business cycle. So what will happen is we will have a transition now. The companies will adapt. There will be some increase in growth compared to the last 3 years. Then there will be another disruption, and then again you will find yourself. So we will have a phase 5. Slightly better phase. Then you'll end up in phase 6 where you again have another disruption, and again there will be a downturn. So it could. So you will have to factor for these. And I'll tell you one more thing. Importance of a company has to reflect in margins, as I said. I'll give you take the case of Nvidia. Okay, its EBIT margins increased from 37% pre-AI, like FY22, to 60% in FY26. So to become more important, companies need to invest. Nvidia invested in designing the AI chips between FY10 to FY20. It was a 10-year journey. A 10-year journey made them important in FY23.
Hari, I love picking your brain, so I'm not going to let you go in this episode without this last question. You talked about the comparisons, these 4 phases, and so on and so forth. And I'm just playing the devil's advocate here. Just for the sake of comparison, the easiest thing for me to pick up is the 2010 to 2014 timeframe, when I think Cognizant popularized this acronym, the SMAC stack, Social, Mobile, Analytics, and Cloud. So at that point in time, they could have looked upon it as an enemy or as an opportunity, whatever. The opportunity was there. I know exactly where I have to invest, what I have to do in order to integrate that into my offerings, all of these 4 components, right? So it was incremental and truly the Indian traditional way. Conservative, incremental investment, hopefully incremental rewards, and sometimes rewards beyond measure. But here, it's almost like it's an invisible enemy or the opportunity. I know you compared Nvidia with Indian IT services companies' margins only for the sake of margins comparison. But if I have to take that example, this is almost like an invisible opportunity, because what could possibly happen, and we've seen examples of Claude, the AI tool, actually writing code or fixing erroneous code. It does not mean to say that IT's jobs will disappear. In fact, like Mr. Anand Mahindra says, we all hope that the opportunities increase and all that. But if that were to happen, the challenge here is that it's an existential question. So where will a company invest if the enemy or the opportunity is not in sight?
See, what I'm saying is it's a different disruption. Everything is different, but the trend is similar. All I'm saying is we will follow a similar trend unless you have a second engine of growth. You need to have a second engine of growth, okay? So,
and what that engine is in respective companies.
And I will tell you this, the second engine of growth doesn't just apply to IT services companies. Sure. It applies even to Nvidia. See, Intel did not have a second engine of growth. That is why Intel has become, Intel trails Nvidia widely.
Yes.
Right? So, Nvidia is now over $4 trillion company. Intel is probably 10% of that, less than 10% of that, okay? So Nvidia was significantly smaller than Intel, let's say 10 years before, okay? So without investing, many companies will end up. It is not just happening in IT services companies. It happens in FMCG companies, but at least FMCG, that is their business, that's it. FMCG globally is a business that gradually declines. Okay, as penetration increase, there is a growth as you penetrate an economy where initially there is lower penetration. Then you reach a certain level of penetration. Then your business slows down. Then you kind of have flattish growth. low single digit growth. That's what happens in the developed economies, which is why they merge and try to reduce costs and all that. I think all of us wouldn't want that to happen to our IT services companies.
Okay.
So they have to invest in second engines of growth. They have to diversify. Then there is a chance they can become more important, as Mr. Anand Mahindra says.
Hari, that was wonderful, in truly invigorating session as we anticipated in the beginning,
you.
and really sets the context for our investors as to what they should think about
Yes.
these numbers from IT
Yes,
services companies
yes.
compared to.
As we discussed, the most important thing that investors need to consider is the importance of IT companies increasing or diminishing in the AI phase.
Okay.
So your answers like that.
Awesome. Thank you. We look forward to seeing you again soon.